All right, let's talk about what's going on, because right now the market has a totally split personality. On one hand, you've got this warm, comfortable feeling from the big picture economy. We're calling it the macro Goldilocks. But on the other hand, there's this cold, chilling fear around AI that's stalking individual stocks. We're going to break down this paradox and figure out what it all means for your money.
So this is the question on every smart investor's mind right now. The big economic numbers look great, inflation seems to be finally getting under control, so why does looking at your portfolio feel like watching a horror movie? It is a massive contradiction, and we are going to unpack it piece by piece.
And this really lays it all out, doesn't it? On the left, you have the macro's warmth, the data telling us everything is just right. And on the right, you have AI's ghost, that fear at the micro level that artificial intelligence is about to just obliterate entire industries. So in this explainer, we're going to walk through both sides, and I promise we'll finish with a clear playbook on how to handle it.
Okay, let's dive right in. A tale of two markets. And we're going to start with the good news, that powerful, warm feeling coming from the big picture. This is the number that really kicked everything off. The January inflation number, the headline CPI, came in at just 2.4%. I mean, that's way cooler than anyone expected. This isn't just a number, you see. It's the permission slip the market has been desperately waiting for. It's the green light for the Fed to start thinking, really thinking, about cutting interest rates.
And boom, look at the impact. The market is now pricing in an 85% chance of a rate cut by June. This isn't just hopeful thinking anymore. Traders are putting serious money behind the idea that relief from these high rates is coming soon. And that expectation, it's now baked into prices.
So where's all that money flowing? This chart tells the story. You see the Russell 2000, which is all about smaller companies, up over 1%, and then look at utilities, a classic sector that loves lower rates, up almost 2.7%. These are the companies that have been absolutely starved for cheaper money. Meanwhile, the tech-heavy NASDAQ was actually a bit down. It's a classic rotation. Money is moving to where it sees the most immediate benefit from lower rates.
Okay, so the big picture is beautiful. Goldilocks is in the house. But this is where our story takes a sharp and, frankly, a pretty spooky turn. Because while everything looks bright from 30,000 feet, a ghost has appeared in the machine, and it's sending shockwaves through very specific parts of the market.
And I mean, listen to how bizarre this gets. A tiny, tiny company, known mostly for making karaoke machines, puts out a press release. They say they're getting into AI-powered logistics. That single piece of paper from a nobody company was enough to set off a multi-billion-dollar panic across the entire logistics industry. It sounds completely insane, but it tells you everything you need to know about how fragile the market psychology is right now.
And here's the damage report. The contagion from what traders are now calling the AI scare trade was swift and it was brutal. Logistics giants like C.H. Robinson and RXO got hammered, down 16 and 15%. But the fear didn't stop there. No, it jumped industries. Pinterest got absolutely crushed, down 17%, all on the fear that some new AI tool will completely upend its ad and search business. The panic is spreading like a virus.
You know, it all comes down to that old Wall Street saying, one that has never felt more true. Sell first, ask questions later. In this kind of environment, the market isn't waiting around for proof of who gets disrupted. The mere threat of AI is enough. It's a market being driven by fear, not just by fundamentals.
But here's the thing. Even in the middle of all this AI-fueled chaos, some companies aren't just surviving, they are absolutely soaring. And that brings us to the ultimate shield against fear, the simple, undeniable power of real, actual earnings.
Let's look at our first case study, Applied Materials, or AMAT. While the market was panicking, their stock surged over 8%. So why? Because their earnings report proved that the AI boom isn't just some story. The spending on AI infrastructure is very, very real. And AMAT has the order books to prove it, with massive demand for the advanced memory chips that are literally the backbone of AI.
And here's another great example from a totally different industry. Look at Rivian. The stock just exploded, up over 20%. And the reason wasn't some futuristic promise. It was a hard-won, real-world milestone. They hit their first-ever annual gross profit. In a market that's terrified of abstract AI threats, tangible execution, actually building and selling stuff profitably, is the ultimate defense.
So, we've got this fierce battle playing out, macro hope versus micro fear. And real earnings are the shield. But there's another, more complicated risk that's lurking just beneath the surface, one that most investors are totally missing. There's a danger hiding in the shadows.
Now, to understand this risk, we have to talk about something called private credit. It's simple, really. It's this huge market for loans that happens outside of the normal banking system. It's where thousands of venture-backed companies, especially in software, get their funding. It's a massive and often very murky part of our financial system.
And this is exactly why you need to be paying attention. A recent warning from UBS flagged a potential $120 billion in new defaults coming from this market. That is a staggering number. It's a potential time bomb just ticking away out of sight.
But what makes this so dangerous isn't just the sheer size, it's the secrecy. UBS is warning that a lot of these loans are mislabeled. What that means is the debt given to struggling software companies is being hidden inside other loan categories. So think about it. If the AI scare trade is right and software values start to collapse, these hidden defaults could set off a chain reaction that almost nobody sees coming.
Okay, that is a lot to take in. We have a good macro story, a scary micro story, and a hidden risk. So what on earth are you supposed to do with all this? That brings us to the final and most important part, your if-then playbook, a clear strategy.
Look, good strategy isn't about predicting the future. It's about having a plan. So here it is. If the 10-year Treasury yield stays below 4.1% and the Russell 2000 small cap index breaks out higher, that's our bullish trigger. The action? Increase your exposure to small caps and biotech. But if the 10-year yield jumps back over 4.2% or a market leader like NVIDIA breaks down, that is our bearish trigger. The action then is to raise your cash level and start rotating into defensive sectors.
All of these conflicting signals, all these cross-currents, they point to one big thing. Something major is happening under the surface. What I'm calling the great money move is beginning.
So what is this move? Well, it's a huge strategic shift away from intangible assets. Companies built on stories and promises about the future, like a lot of software companies, and a move toward tangible assets. We're talking about companies with real cash flow, companies that build a real infrastructure for AI, companies with real products you can actually touch. In short, substance is replacing story.
And that leaves us with the one question that is going to define this entire era for investors. In an age that is dominated by both the incredible promise and the terrifying fear of AI, where is real lasting value actually hiding? That's the challenge. And that's the opportunity.